this. So इसमें स्पीकर है ना?
पता नहीं है, होना तो चाहिए.
हाँ हाँ, people are able to.
Hi, good morning, sir. Am I audible? Sir, right turn.
Yes, you are audible.
So can we start the session now?
Yes, yes, let us start. We are already very late.
Yes, yes.
Yes, I am extremely sorry, participants, for this unreasonable delay. There was some technical issues because of which we got delayed. Now we are so just give me 1 second. One second, party. Just give me a moment. The slides will come. Start again. Good morning, everybody. I am extremely sorry for this delay. So today's topic is very, very important. That is input tax credit, and we know that the most of the litigation which are arising right now are related to the input tax credit, and in the time to come also, I expect that a lot of litigation will arise relating to input tax credit. So to start with, I will divide my presentation into two parts. First is the part relating to interpretation of the provisions relating to the input tax credit, the substantive part of it, that is section 16, section 17, and the issues which may, interpretational issues which may arise out in relation to these two sections. And then I will discuss some of the important litigation issues which are arising relating to input tax credit and how to handle those issues. So first of all, section 16 of the GST Act says that every registered person is entitled to input tax credit with respect to goods or services which are used or intended to be used in the course or furtherance of business. So this is very, very important as to the input tax credit which is admissible in the GST era, if it has relation to or incidental to or intended to be used for in the course or furtherance of the business, then the credit is admissible. So in the central excise era, the relationship which needed to be established was whether it is in relation to the manufacturer. In the VAT, it was if it is in relation to the sales or in relation to the manufacturer. Different states had their own version of the basic elementary conditions for allowing input tax credit. But in the GST era, it is much more wider in scope than it was in the era of central sales tax, in the era of VAT or central excise or service tax. So the scope is the widest in the GST era, and in trying to understand as to what is incidental or in relation to the business, I think we can borrow some of the judgments or the jurisprudence which arose in the context of the Income Tax Act, because in the income tax also the expenditure is allowable if it has relation to the business. So in that context, various judgments have laid down the scope of in relation to the business, and one of the ratio which has been laid down by the Honorable Supreme Court is that the officer or the revenue cannot enter into the wisdom of incurring an expenditure. What is essential, what is not essential, what is commercial expediency, that can only be decided by the concerned businessman and not by the revenue. So the necessity or otherwise of incurring an expenditure can never be questioned by a tax officer, and it is the sole discretion or the jurisdiction of the business entity. That is point number one. Then secondly, for the purpose of business is wider in scope than for the purpose of earning profit. So suppose some social expenditure is incurred which does not result into earning of the profit but result into the brand building of a entity, then that business has to be allowed irrespective of, again, the commercial wisdom, whether the concerned expenditure is resulting into some profit or not. There are various types of programs which are conducted by a business entity, and I am telling you that from this finance budget, CSR expenditure, that is the corporate social responsibility expenditure, which are incurred mandatorily in terms of Companies Act, have become part of the blocked credit, and credit is no more admissible. But besides that, a commercial entity in its wisdom may conduct various social welfare programs, necessarily strictly in accordance with the CSR expenditure, and they are not part of the CSR expenditure, but they are incurred by the business entity, which gains them some visibility in the society, and which may not directly relatable to the earning of the profit. So those expenditure will also be allowed. Now, in the context of the VAT era, one interesting dispute or issue arose, whereby the purchases made by the research division. You see, the research division is directly not participating or have relationship with the live business, because its objective is to do some research which may benefit the entity in future, but the immediate manufacturing activity which is conducted by a business house and the research division of a business entity may not have the direct may not have the immediate benefit. So there was a dispute which went up to the High Court, and the Honorable Karnataka High Court decided that the claim of input tax rebate in respect of the purchases effected by its research division is very much admissible. Now the second question arises is that is it necessary to have a one-to-one correlation ये मेरा वीडियो चला गया है क्या?
No, no, your video is working, but slides are not moving.
स्लाइड तो मूव किए हैं ना?
हाँ, move किए लेकिन उसमें show नहीं कर रहा था कि सब participants पूछ लीजिए एक participant.
Is my this slide visible to all? Or PPT is not visible.
So एक काम कीजिए, slide show रोक दीजिए. Slide show से back कीजिए, escape कीजिए.
Oh, it is paused. Your screen sharing is paused. Why it is paused?
You again share ना sir. Stop it and again share.
Is it visible now? Yes. Thank you. So another issue is that suppose a entity in the same manufacturing premises or in the same company are dealing in multiple products and services also. So is it necessary to have a one-to-one correlation between those input and output and maintain separate input register for different products? So therein this issue or the dispute arose in the earlier central excise era also, and the Honorable Supreme Court has held that there is no requirement of establishing one-to-one correlation between the input and the output. It is good enough if it is used in relation to the business. In the erstwhile era, it was manufacturing. So as long as the entity which is manufacturing an item or more than one item, they are used in relation to the business, there is no need to maintain separate baskets of the different input and outputs. And it is good enough if they are used in relation to the business. And credit on any input can be used for any taxable product. So this is also very, very important. And secondly, it in the context of VAT era, one issue which also arose is whether the input and output should relate to the same tax period. That is, you have purchased the goods in the month of March. So is it necessary that you should claim the credit in the month of March itself and link it to the your output of the final product relating to that month? That is also not necessary. It need not be having the link to the same tax period. It need not have link to the same product. And it is good enough if it has linked to the business which you are conducting. Now, there are various conditions to claiming of the input tax credit, and section 16 subsection 2 prescribes that. These are very, very important. First condition is that you must be in possession of the invoice. Secondly, a newly introduced condition, that is 16(2)AA, which has been introduced with effect from 1st of January 2022. It says that your supplier must have filed its GSTR1 return, that is its supply return. Thirdly, you must receive the goods or services. Fourthly, the effect of the goods or services must be paid by your, and you must file your return in order to claim the input tax credit. Now, there are several proviso to section 16(2), and second proviso says that if you don't make the payment to your supplier within 180 days, then you need to reverse the credit. बोल रहा इंटरनेट कंडीशन is video working now?
It's clear, go ahead.
Am I audible and visible?
Yes, sir.
Okay, thank you. So now the question which arises in my mind and which I want to ask to the participants is whether, suppose you don't make the full payment and issue a discount to the supplier, whether it can be considered to be a payment. Okay, so there are, you see, some of the participants who has opined that the discount can be considered as payment, and you see in the erstwhile era, there are judgments which says that if the issue of a credit note can also be considered to be a payment. And you see, there are two authority for advanced ruling judgments also, which says the same thing, that if the discount is issued post supply, then that has to be considered as payment. What's going on? तो उसको बोलो ना समझो. Okay, now let us talk about some of the restrictions which is there in section 17, subsection 5, with respect to taking of the credit, which is called the block credit. मेरा वीडियो चला गया है क्या? Okay, so under section 17 subsection 5, I think one of the important issue with respect to disallowance of the credit is the blocking of the credit on the immovable property. Now, subsection 5 clause C says that the works contract services, when supplied for construction of service, the input tax credit is not admissible. But there is an exception that even if it is an immovable property, but if it happens to be plant and machinery, then input tax credit on works contract service is also allowed. Now, plant and machinery is defined in explanation to section 17 subsection 5. It says that the plant and machinery means the apparatus, equipment and machinery fixed to earth by foundation or structural support that are used for making supply takes the color of a immovable property, the input tax credit is allowed. Participants, what I want to do is that I want to switch over to some other device where the internet connection is stable, because here the internet connection is not so stable. So just give me a moment. I'm extremely sorry for this today's disruption because of some internet connection at my end. Okay, so the plant and machinery is not allowed as credit. Plant and machinery is defined in the explanation, and it excludes land and building. Now here, one of the important distinction which we need to see is that in clause D, it uses the word plant or machinery. So the clause C says that while the plant and machinery, if there is a plant and machinery, then the input tax credit will be allowed. But the definition of plant and machinery is restricted because it does not allow credit on the land and building. Now there may be several scenarios where even though my land and building is the only source of providing my service, but I will not be allowed the input tax credit. For example, let us take the case of a hotel or a warehouse which is let out. Now the hotel cannot function without the building, and a warehouse also cannot be let out without there being a civil structure in existence. So the entire purpose of the GST, where first of all, in the GST era, for the first time, it was said that the purpose of the introduction of the GST law is to eliminate cascading effect of tax. Till now, there was no prior to the GST era, there was no constitutional mandate to eliminate cascading effect of tax. So there are various Supreme Court judgments which says that it is a concession granted by the government, and therefore, if as per the policy of the government, if the act does not allow, then the credit should not be allowed also. But in the GST era, it is for the first time that it can be said to be a constitutional mandate, because at the time of the constitutional amendment for the purpose of introduction of GST, the removal of cascading effect of tax was one of the primary goal. So if somebody's entire source of income or the main source of income is that immovable property, and if the credit is not allowed, then it goes against the constitutional objective. Secondly, in clause D of the section 17(5), it uses the word plant or machinery. Now, plant or machinery is not defined in the GST Act, but the word plant has been interpreted by the Supreme Court judgment in the context of income tax in the earlier era, and it has been interpreted to refer to a tool of trade required by a business for running its business operation through repeated use, and it can even be a building. So one may argue or interpret that even if it is a building and it falls within the purview of clause D of section 17(5), suppose you get a building constructed, you supply the material and you engage a contractor who is not a works contractor, then you see one can argue very well that you see the plant which I am getting constructed is very much a tool of trade required for running the business, and therefore the input tax credit should be allowed to me. Again, they are saying your am I not audible? Okay, thank you. You see, now another, I think the issue where the interpretation will arise and the disputes will arise is with respect to section 17(5), clause H, which says that the input tax credit is not admissible with respect to goods lost, stolen, destroyed, written off, or disposed of by way of gift or free sample. Now, one of the issue which arises immediately in mind is whether the ITC will be allowed in case of a gift or say buy one get one free. The word used in such scheme say is that one item will be given free if you buy one. So the question which arises in my mind is whether in such a scenario the ITC on the item which is given free can be considered to be a gift and therefore ITC will have to be reversed with respect to that one item which is given free of cost. So I invite the view of the audience about this particular issue. Okay, Mr. Chandrasekharan is saying it is for the furtherance of business, so ITC is allowable. Okay, anybody else? Mr. Piyush Sangoi is saying no, as ideally the amount of free goods are considered in overall costing. Say Siddharth is saying yes, it is allowable. Mr. Shiv Kumar is saying it is restricted and not allowable. You see, with respect to this particular issue, fortunately, the government itself has clarified this particular issue. There is a circular number 92/11/2019 dated 7th March 2019, where it has been clarified that the buy one get one free does not mean that the product is giving free of cost. In fact, it is supplying two goods for the price of one, and therefore ITC is very much available. Now, further issue is with respect to the writing off. Suppose the goods are not written off completely, but they are written down. Suppose the price of the goods, the normal price of an item, it's say 100 rupees. But due to some reason, because they are partially damaged for this reason or that reason, and the price of such goods is written down. Say the price of goods of 100 rupees is written down to say 10 rupees because they are expected to face some scrap value. Then whether ITC will have to be written off proportionately or completely? What is your view? I'm again asking the question, suppose the goods are partially damaged, not fully destroyed, and the value of such goods are partially written off in the books of accounts, then whether the ITC proportionate to the written down value will have to be reduced or fully the ITC will have to be reversed, what should be done? Mr. Bad is saying it should be allowed in full. Mr. Piyush is saying ITC allowable fully. It has to be reversed, Mr. Aditya is saying. Fully allowed, Mr. SSV. No reversal requires, full ITC allowed. Yes. Okay, so my view is also the same. We can claim full credit because there is no restriction of ITC if the goods are sold below the actual price. You see, in the erstwhile era, there were some of the state weight laws which restricted the ITC to the extent the goods were sold below the cost price. But that is not the case in the context of GST. ITC is fully allowable if they are used in relation to the business. And secondly, Section 17(5) nowhere restricts the ITC to the proportion the goods, the value is written down. Only if the value is completely written off or if the goods are completely destroyed, which does not fetch any value whatsoever, only then ITC will have to be reversed. So if the goods are destroyed, say in totality, then ITC will have to be reversed. If the goods are completely written off, then ITC will have to be reversed. But if the goods are say partially destroyed and they are sold as a scrap, then ITC need not be reversed. Further, if the goods are partially written down in the books of accounts, then also ITC need not be reversed. Now, what is the meaning of the gift? Gift means something which is given voluntarily without any consideration. So, in my opinion, suppose some dealers are given some promotional items for the purpose of furtherance of business as part of the scheme, then it should not be considered as gift because it is for the purpose of promotion of their business, for the purpose of relationship with the dealers, and therefore it cannot be considered as gift because it is given out of the business consideration, and therefore ITC should not be reversed in such a case. Only if it is given to a stranger having no business relationship and with no reciprocal expectation of furthering the cause of the business, only then the ITC should be reversed. Now the another issue which arose in the erstwhile era and which has been comprehensively dealt with even by the Supreme Court, that the process loss, something, suppose the input is lost in the course of the production, then it cannot be considered to be goods not used in relation to the business, and the input tax credit should be allowed. It cannot be that we have to find out an exact mathematical equation between the raw material used and the goods raw material found in the finished goods. It is not at all possible to conduct business in such a manner. So even if there is some process loss and there is a waste in the course of the manufacture, then such a process loss or waste arising in the course of the manufacturing cannot be considered to be goods destroyed or lost, and therefore in my view the jurisprudence which is there in the erstwhile era will continue to remain applicable in the GST also, despite the denial of the input tax credit on the goods lost, destroyed or written off. And in my view, if there is a loss which is a process loss in the course of manufacture, then ITC should not be denied. Further, there may be loss arising due to evaporation during the manufacturing process. There may be, for example, oil, which is kept in an oil tank and there is a evaporation loss. Now, such a evaporation loss cannot be considered to be goods lost or destroyed, and ITC need not be reversed in such a case also. Further, there may be a transit loss either at the time of in the course of transportation of inputs or in the course of transportation of your finished product. But this kind of loss is also a loss intrinsically connected with your manufacturing process or the process of the business. So the handling loss in the process of either receipt of the goods or in the course of manufacture, or the spillage or pipeline losses, they are very much in relation to the business, intrinsically connected to the business, and in my view they cannot be considered to be the goods lost or destroyed, and therefore input tax credit should be allowed on such losses also. Now, it may be that there is some small quantity which is a normal loss in the course of receipt of the goods, then it has to be allowed. Now there is this Punjab and Haryana High Court judgment which says that Sanvat credit not deniable when input destroyed in fire accident. Now this is something you see which will have to be tested in the time to come in the context of the GST era, because whether or not it has link to the business, if the fire is not deliberate or not due to error or omission or say negligence of the business person, and it arises in the natural course, then can one not say that it is not destroyed because of some negligence on my part, and therefore it is very much in relation to the business and the credit should not be denied. Now another issue which arose in the erstwhile era is that the Sanvat credit, because you see in many times some item is given as free with the sale of the primary item, something which is not there is a circular relating to buy one get one free, but it may so happen that in order to promote sale of items, sometimes something else is given as a gift, particularly with respect to the items relating to the children. Some toys or something like that is given as free. So there is a judgment of the tribunal in the erstwhile era where the playing card given as a gift along with the final product was allowed as input tax credit or Sanvat credit as it was called during that time. Now I come to some of the disputes or the litigation issues which are arising in the context of the input tax credit. Mr. Siddharth, the thing is that what we are trying to do is to decipher the jurisprudence which is already available in the erstwhile era. Now, we all know that circular does not create any binding precedent on the court of the law. So the court can always interpret any provision of the law in the manner in which they wish without referring to the circulars. So I think it all depends on the particular entity, whether they want to take a chance commercial wisdom, and you see the considering the amount involved in the particular matter. Now let us discuss some of the issues with respect to litigation issues which are already arising. And one of the most, I think, the prominent issue of litigation is mismatch between GSTR 2A and 3B. You see, I see that the department, on the basis of the analysis of the data on the GSTN portal, if there is a mismatch between GSTR 2A and 3B, they are issuing notices. And in some of the cases, even without issuing a formal show cause notice, they are asking the entity to reverse the input tax credit. Now, this particular dispute, I would like to divide into three era or three parts. One is that up to a mismatch because Section 43 and 42 was never operationalized, and subsequently they've been deleted from the act also, because GSTR mismatch concept or the matching concept could never be made operational because of the portal issue. Now, with effect from 9th October 2019, Rule 36 Sub-Rule 4 was introduced, by virtue of which there was a restriction in the taking of the credit on the basis of the matching of the data with the GSTR 2A. But this Rule 36 Sub-Rule 4, which was introduced, never had any legal backing because it drew its power from Section 43, Section 43, capital A, subsection 4. Now, since this Section 43, capital A was never notified, and subsequently by way of Finance Act 2022, it has been omitted. So Rule 36(4), which had its source of power from 43A, 43A never having been notified. So Rule 36 is clearly contrary to Rule 36 Sub-Rule 4 is clearly contrary to the GST Act itself, and any rule which does not have power given by the Act is ultra vires to the Act, and it is liable to be set aside. Now, this Rule 36(4) is under challenge before various high courts. We have not yet seen the final outcome, but I'm very sure as and when any court decides this particular issue, this Rule for 36(4), to the extent it is contrary to Section 43, capital A, which has now been deleted from the Act itself, will be held to be ultra vires. But from 1st of January 2022, Section 16(2)AA has been introduced, which is now almost identically worded to Rule 36 Sub-Rule 4. So if you read Section 16(2)AA and Rule 36 Sub-Rule 4, there is not much of a difference. So it is invalid. Rule 36(4) is invalid for the period from 9th October 2019 to 31st December 2021. But with effect from 1st of January 2022, at least it is in consonance with the Act, and it is not ultra vires to the Act. But still, one may see whether 16(2)AA itself is unconstitutional. Because if any act is unconstitutional, then it is liable to be set aside. Now, and therefore it violates Article 14 of the Constitution of India. Now, why it is arbitrary? It is arbitrary because it imposes an impossible burden on the buyer to ensure that the supplier files his GSTR 1 return. Now, the buyer has not been given any power under the law to ensure that the supplier, in fact, complies with the law. He may withhold his payment if he fails to comply, but accept some commercial control over the action of his supplier. There is no power under the Act given to the buyer to ensure that he does. In fact, the payment terms may be such that the buyer is supposed to make either advance payment or payment simultaneously with the purchase of the goods much before this condition of GSTR 1 can be complied with. So if suppose somebody has already made the payment to his supplier, then how does one ensure that his supplier files his GSTR 1 return? There is nothing in his hand. So according to me, this 16(2)AA is unconstitutional, and therefore 16(2)AA will also someday or other will be struck down by the high courts and also by the Supreme Court in the time to come. Now, with respect to this mismatch, there are two periods. One is up to October 19, there is no mismatch. There is no restriction. So, to deal with the litigation which has already arose for the period 17-18 and 18-19, now CBIC before any appellate authority, then this issue can be disposed of subject to the condition prescribed in this circular. Now, this circular says that the credit will be allowed if the supplier has filed return in form GSTR 3B. That is one of the primary conditions. There are various scenarios because of which the GSTR 2A is not there. Suppose you have purchased it B2B, but the supplier files his return B2C, then it will not be seen in your GSTR 2A. Or suppose there is an error in terms of the GSTI number in the filing of GSTR 1, or GSTR 1 does not capture your sales, but GSTR 3B is filed. So first of all, the GSTR 3B must have been filed. If the GSTR 3B is filed, then the proper officer shall ensure that the other condition of section 16 are fulfilled, that the goods are received, it is covered by invoice, and other such conditions are fulfilled. And also the proper officer should look into whether any reversal is required in terms of section 17 or section 18. Am I audible properly now? Okay. So primarily you will see that the section 17 and 17, 16, 17, 18 other terms and conditions are complied with. After that is done, then the first thing is that it needs to be seen whether tax has been paid by the supplier. And if that is clear, then a chartered accountant or a cost accountant can issue a certificate certifying that the supply in respect of the said invoice has actually been made by the said supplier, and the tax on such supply has been paid by the said supplier in his form GSTR 3. If the value of the dispute exceeds 5 lakh, then a certificate from the chartered accountant can be taken or a cost accountant can be taken. And if the value of the supply is less than 5 lakh, then the certificate from the concerned supplier can be taken that he has paid the tax and he has also supplied the goods to you. Now the difficulty here is that whose CA should certify this, whether it is the auditor of the supplier or whether it is the auditor of the buyer or any other chartered accountant. In my view, there is no such restriction given in the circular. any chartered accountant, whether auditor of the supplier, buyer, or cost accountant, not connected with the audit or certification of the books of accounts of the either buyer or supplier can certify. But the difficulty for him will be to ensure that the supplier has made the supply, so it is not a fake supply, and secondly, the tax by the supplier has been paid. So once these two conditions are satisfied, then on the basis of the chartered accountant, this particular dispute can be resolved. Now let me take some of the questions in connection with these issues, which is there in the chat box. One of the question is whether the circular 183 can be cited in appeal against rejection of refund of accumulated ITC entries not in GSTR 2A of. Yes, this can be cited in appeal also. It is mentioned in the circular itself. Nowadays, Mr. Ashwini Kumar has asked, nowadays if one party closes its business at surrender's DI STN, then NT-Vason send notices to their vendor for giving the input that you have done fake invoices. We will deal with this. Late filing of GSTR 1 by supplier and the department is not allowing credit on the basis of late filing return. Now another issue, I think, which is one of the most prominent issue which many of the business entities are facing is that you have received the goods, but for some reason or other, subsequent to the receipt of the goods at your end, your supplier is not found at its place of business. They have either shut down their business, or probably due to some issue or other, they are no more available in the place of business where they earlier used to exist. And they probably have also stopped filing their returns, so they are a defaulter also. So because of all these reasons, suppose the department makes a physical verification of their premises, then they come to the conclusion that they are no more existing in their place of business and their registration is cancelled. So a so-cause notice is issued to the buyer of such entity saying that ITC should be denied to you because your supplier is non-existent. And therefore the invoice which has been issued is a fake invoice. In many such instances, the statement of either that supplier or some other entity is also taken. In many a scenario, they are taken under caution. The statements are tied by the departmental authorities also, and they are made to write that they never existed, and they are in the business of supplying fake invoices or the paper invoices only, and they have never supplied the actual invoices. But you have received the goods. It is covered by the proper documents. You have the documentary evidence for the receipt of the goods also. For example, you have the electronic e-way bill, you have the proper consignment note, you have the waybill note also, and some of the supplier also take nowadays photograph also to avoid such kind of a scenario when the vehicle is entering their premises. So they are, you see, covered by all possible documentary evidences which one can have to establish their bona fide. So once you have discharged that primary burden of all the documentary evidences, then you should submit whatever is there available with you to support your contention that your transaction is genuine. And secondly, one should seek a cross-examination of the party whose statement is the basis to deny you the benefit of input tax credit. Because it is an established principle of law that no assessment can be done on the basis of a third party information without the benefit of cross-examination. I have given citation here in the context of Sales Tax Act, Income Tax Act, wherein it is a consistent view of the Honorable Supreme Court that in the absence of the benefit of the cross-examination, the entire proceeding is null and void. So, at the earliest, you should seek cross-examination, write a letter to the concerned authority that please allow me the benefit of cross-examination of the parties whose statement you are relying upon to say that the transaction is fake, the invoice is fake. And you should also submit all the documentary evidences which you have in your possession to establish the bona fide of your transaction. Now, another issue also, connected issue, which many entities are facing is IT reversal due to cancellation of registration of the supplier. Now, here in many cases, because they are not filing their return or they are not found in their place of business, their registration is retrospectively cancelled from the date of the registration itself. So therein, in many cases, the department is not even issuing the supposed notice. They are either writing a letter or sending an email that please reverse your input tax credit because your registration of your supplier has been cancelled with retrospective effect. Now, here there is a Supreme Court judgment in the context of the sales tax era, wherein it was held that a purchasing dealer is entitled by law to rely upon the certificate of registration of the selling dealer and to act upon it. Whatever may be the effect of a retrospective cancellation upon the selling dealer, it can have no effect upon any person who has acted upon the strength of a registration certificate when the registration was current. Now, there are similar judgments of other high court also in the erstwhile VAT era. For example, there is a judgment of the Gujarat High Court, there is a judgment of the Delhi High Court, and there is judgment of the Madras High Court also. All these judgments are in the context of the VAT Act, wherein the input tax credit benefit was denied because the registration of the supplier was cancelled. Now, in all these cases, the Honorable High Court says that, look, you cannot deny the benefit of the ITC merely on the basis of cancellation of registration of the supplying dealer. Whether it is prospective effect, whether it is with retrospective effect, it is not material. Now, herein in the context of the GST Act, there is a judgment of the Honorable Calcutta High Court also, wherein the input tax credit was being denied. Number one, because the supplier is non-existent. Secondly, it was said that the suppliers are non-existent. So after taking everything into account, the Honorable Calcutta High Court said that prima facie it appears that all the documents which are necessary to establish the bona fide the party has already submitted. So it directed the concerned officer that you look into all the documents and the transaction in question. And if the transaction is genuine and all those transactions has taken place before the cancellation of registration of the supplier, then the benefit of input tax credit cannot be denied to the buyer. Because the buyer cannot do anything about the non-existence of the supplier from its place of business subsequent to the transaction. It is not in his hand to ensure the continued existence of the supplier at its place of business after the transaction has been concluded. Now, Mr. Rajesh Bedi is asking, can the department disobey the jurisdictional high court? Certainly not. It is a well-established principle of law that whatever is the judgment of not only the concerned high court, but even tribunal, it is binding on the officer and they are bound to follow it. Now let us look at the other scenario, whereby suppose the genuineness of the transaction is not in question, but the input tax credit is denied because the tax is not paid by your supplier. Now that is covered by section 16(2)(c), which clearly says that in one of the conditions to avail input tax credit is that the tax must have been paid by the supplier. Now, ordinarily, you cannot deal with this kind of a situation by filing a reply to the so-called notice. The only recourse in such a scenario is challenge the constitutional validity of section 16(2) subsection C. Now, let me tell you that analogous provision existed in erstwhile VAT Act also of the various states, where the benefit of input tax credit in the VAT Act was being denied because the supplier has failed to make payment of the tax to the government exchequer. So herein, in one of the very elaborate and judgment of the Honorable Delhi High Court, it was held that the benefit of input tax credit cannot be denied to a buyer until and unless there is a collusion between the buyer and the supplier to evade the tax. The department must lay evidence to the effect that there was a collusion between the buyer and the supplier. Unless that is there, the benefit of input tax credit cannot be denied. It was held that such a denial is violation of Article 14 because you cannot treat unequals equally. If there are two people who are unequal, then they cannot be treated equally. At the same time, Article 14 says that equals also cannot be treated unequally. So here, on the basis of this principle of Article 14, which says that unequals cannot be treated equally, the Honorable Delhi High Court said that it is violation of Article 14, and therefore they read down the particular provision and said that if you cannot treat a guilty purchaser with the innocent purchaser, an innocent purchaser has one who has acted bona fide and who has genuinely entered into a bona fide business transaction, and it is because of the default of the supplier that he has failed to make payment of the it is because of the default of the supplier, the benefit of the input tax credit cannot be denied to the buyer. Now, against the particular judgment of the Delhi High Court, the department filed an SLP before the Honorable Supreme Court, and that SLP was also dismissed by the Honorable Supreme Court. Now we have the judgments of the Honorable Madras High Court, Honorable Rajasthan High Court, Honorable Punjab and Haryana High Court, Honorable Jharkhand High Court also in this particular issue, wherein it has been held that the benefit of input tax credit cannot be denied solely on account of the failure of the supplier to make payment of the tax. Herein also one of the important principle of law is that, which is called a lex non cogit impossibilia, means law cannot compel a person to do something impossible. If something is not in the hand of a particular person, then the law cannot enjoin a responsibility or duty upon the person to perform such a task. And there are several judgments in this context where if any such impossible condition is imposed by the law, then it is liable to be struck down by the courts. And there are several judgments which I have referred to in this particular slide, and I believe that they will be useful in dealing with the constitutional challenge to section 16(2)(c) before various high courts. Now another issue with respect to demand of input tax credit is that the supplier has not made the payment of the tax, and supplier has gone into either liquidation or insolvency proceeding. Now we know that the insolvency code overrides any other law. So if in any other law, if anything is inconsistent, then that will be overridden by the insolvency and bankruptcy code. Now, if any entity goes into the liquidation or the insolvency process, then it might so happen that at the end of the supplier, as part of the liquidation proceeding, the department will lodge its claim. Suppose 100 rupees of tax is due, then they will lodge its claim before the resolution professional. Now, as part of the resolution plan, ultimately, it might so happen that out of that 100 rupees, only say 10 rupees or 20 rupees or 50 rupees is paid to the department, and 50 rupees is not paid. Now, can the benefit of input tax credit be denied to the buyer to the extent that it is not recovered from the supplier as part of the liquidation proceeding or insolvency proceeding? Now, here I believe that a judgment of the Honorable Supreme Court in the context of GST Act should come to your rescue, because it said, and the judgment is which I am referring to is the judgment of Ghanshyam Mishra and Sons versus Edelweiss Asset Construction. Here the Honorable Supreme Court said that all the dues, including the statutory dues owed to the central government, state government or local authority, if not part of the resolution plan, shall stand extinguished, and no proceeding in respect of such dues for the period prior to the date on which the adjudication authority grants its approval shall be continued. So here, the ratio of this judgment is that all government dues, to the extent it is not part of the resolution plan, stand extinguished, and any proceeding in relation to such dues shall also stand concluded, and it cannot be allowed to be continued. So my opinion is that any proceeding, if at the end of the supplier cannot be allowed to be continued, then any recovery proceeding at the end of the buyer is also a proceeding in connection with the dues at the end of the supplier. So as per the ratio of the judgment which is laid down by this Honorable Supreme Court, if the proceeding cannot be continued at the end of the supplier, then in my view, the proceeding cannot be continued at the end of the buyer also, because the proceeding which is initiated at the end of the buyer is in relation to the dues from the supplier only. Now the proceeding stands concluded at the end of the supplier. The dues is also extinguished. So once it is extinguished at the end of the buyer, it cannot be reclaimed at the end of the supplier. Then it cannot be reclaimed at the end of the buyer. Now the another issue or the another dispute which is arising is a violation of section 16(4). Here most of the dispute which I have seen is relating to the delay in filing of the return. Suppose for the period of 1718 or 1819, section 16(4) says that input tax credit will not be allowed beyond the due date of the filing of the return, which follows a financial year. September return which follows a financial year. So for the for the purpose of 1718 financial year, the due date, say for 1819, I am taking the example. 1819, the due date of filing of the return was September 19, October 20. Now suppose the return is filed in the month of November or December. Now the department will say that you have violated section 16(4) because you have filed your return beyond the due date as it is prescribed in section 16(4). So you are not entitled to input tax credit. And department is issuing notices. In many cases, they are not even issuing notices. They are directly writing an email or a letter saying that, look, you have violated section 16(4). Therefore, please reverse ITC to the extent of so and so amount, which is in violation of section 16(4). Now, how do you handle such a issue? Now, first thing which you must do is to obtain a CA certificate with respect to the date of taking of the credit in your books of accounts. Now, in my view, the input tax credit is not taken in the return. It is taken in the books of accounts. Section 35 of the GST Act says that you have to maintain books of accounts of the input tax credit available. Rule 56(4) says that you maintain books of accounts containing the detail of the input tax credit, together with the register of tax invoice, credit note, debit notes, delivery challan received or issued during the tax period. Now, my question is, do you take credit in the return or do you take credit in the books of accounts? Now, my opinion is very clear that you take credit not in the return, but in the books of accounts. So, if you have claimed the credit in your books of accounts, then irrespective of the facts that there is a delay in filing of your return beyond the due date as it is prescribed in section 16(4), it is not barred by section 16(4), because till the time your return is allowed to be filed by taking the late fees and also the interest which is liable to be paid for the delay in filing of the return, you cannot be debarred from claiming the benefit of the input tax credit. Now, in this context, there is a judgment of the Honorable Supreme Court also in the context of, in the case of Airtel India Limited, wherein it was decided that you take the credit in the books of accounts and not in your primary source of taking the credit, input tax credit is your books of accounts and not the portal. Therein the dispute was that the concerned company claimed that it could not claim the input tax credit during the initial period, that is July 2017, because GSTR 2A was not made operational. So because the GSTR 2A was not made operational, they did not take credit at all. So therefore, they say that the failure to take input tax credit was on account of the failure of the portal and not there. So in that context, that judgment was rendered, and it was held that you don't depend on the portal to take credit. The credit is taken through the books of accounts. The primary source is your books of accounts. So the benefit cannot be denied just because the GSTR 2A was not made operational. So I think the similar logic will also apply with respect to section 16(4) disputes. If the credit is taken in your books of accounts, then you should be entitled to the credit irrespective of the delay in filing of the return. Now, in order to ensure or certify that the credit in books of accounts were taken within the time period as prescribed in section 16(4), it is advisable to take a chartered accountant certificate and file with your reply, so that you are in a position to corroborate that the credit was taken very much within the time prescribed in section 16(4) in your books of accounts. So therefore, credit cannot be denied to you. Now, with this, I conclude today's discussion. I will now take some of the questions which is already there in the chat box and the question answer box, and you can also raise further questions. Mr. Ashwini Kumar is asking, any Delhi High Court case on cancellation of registration? No, there is no judgment as of now, according to me. Now, another question is that the party suo motu surrenders its GST and then notice to his vendor for fake invoices. Which case supports this situation? You see, whether party suo motu is surrendering its GST or whether it is cancelled by the department, according to me, it is not relevant. As long as you are in a position to establish the bona fide of your transaction and your transaction happened prior to the date of cancellation of the registration, the credit will be allowed to you. Now, Mr. Arvindan Aj is asking, ITC on few invoices are rejected on the ground that PO is not recipient state. This is mostly found while filing GSTR 9. By that time, due date for amending GSTR is over. You see, there is no condition which says that, which talks about the place of supply with respect to the taking of the input tax credit. So according to me, this condition, this demand of the department that place of supply is not of recipient state is not something which is on the basis of section 16, 17 or 18. So until unless you see there is a debarring provision under either section 16, 17 or 18, the benefit of input tax credit cannot be denied. Now Mr. Purushottam Gopalan is asking one more condition imposed under section 183 CA certificate, which nowhere in section 16. Is this circular ultra virus? Yes, Mr. Gopalan, I totally agree with you that this circular 183 is ultra virus, because no condition which is there in the act itself cannot be added by way of a circular. This is an established principle of law. So definitely to that extent, it is ultra virus. But I would like to look at it another way also, that it is beneficial in the nature because it is trying to resolve the dispute by giving you an opportunity of corroborating the bona fide of your transaction through the certificate of the supplier if the value of the supply is less than 5 lakh, or if the value of the supply is more than 5 lakh, then through the value, through the certificate of a chartered accountant or cost accountant. So in my view, even though this circular is ultra virus to the act, but I believe one must take the benefit of this circular and try to get the dispute resolved. Here, Mr. Ashwani is asking, SSC got so-called notice under DRC 01 and paid the penalty. Where can we file the appeal on the same? Goods were confiscated due to mismatching of signature on invoice. Temporary ID is generated by UP government. You have to file your appeal to the in the jurisdiction of UP government only, because wherever you see you have been given temporary ID, and whichever authority has confirmed demand against you, you have to file appeal in that jurisdiction only. You cannot file jurisdiction elsewhere. The SSC purchased a car for the purpose of his travel to promote his business. The ITC on car availed, and we interpret it is in the furtherance of his business. An ITC availed cannot be denied. You see, Mr. Chandrasekhar, this is clearly covered under section 17(5), that benefit of such a motor vehicle is not admissible. So therefore, until unless you challenge the particular provision of section 17(5), the benefit cannot be allowed to you. Yes, Mr. Ashwini, appeal can be filed online. I am sharing my email ID also. If anybody has any question, they can mail it to me. I will try to answer them. I think there are no more questions. So with this, I would like to conclude today's session. Thank you very much, everybody. Thank you.
Hi, sir. Hello, sir. Am I audible?